Okay, so you want to own an HVAC company. The fantasy is simple. People will always need heating and air conditioning. Summer heat waves and winter freezes aren't going anywhere. Every home, every office building, every hospital, every data center, every grocery store relies on the machines that move heat from one place to another. When those machines break, the phone rings. You send a truck, you fix the problem, you collect the check. It feels like a necessity business, a recession-resistant trade where a skilled technician with a van can build a comfortable life and maybe, just maybe, a real company. Then you look closer, and you realize that owning an HVAC company is not about fixing broken machines. It is about managing a fragile system of perishable labor, expensive metal, and contracts that can vanish with a single missed appointment. The owner walks into the shop before dawn, not to turn a wrench, but to see if the trucks are full of gas. The technicians are sober, and the phone is ringing. The fantasy breaks the moment you understand that demand is not the same thing as profit. To understand this business, you have to stop looking at the air conditioner and start looking at the structure beneath it. The legal permission to handle chemicals that can destroy the atmosphere, the cost that appears before any revenue is earned, the contracts that control the owner, and the one number that decides whether the asset is building wealth or quietly burning cash. The first gate the owner encounters is the law. This is not a business you can start from your kitchen table with a wrench and a good attitude. Under Section 608 of the Federal Clean Air Act, the Environmental Protection Agency mandates that any technician who might release refrigerants into the atmosphere during their work must be certified. This is the legal baseline, but it is only the beginning. States impose their own licensing regimes. Local municipalities require permits for each job. The law is not paperwork. The law is one of the walls around the cash flow. It determines who can enter the market, what safety standards must be met, and what liabilities the owner carries if a refrigerator leaks or a furnace is installed incorrectly. Ignore the law, and the business is not a business. It is a lawsuit waiting to happen. The owner quickly learns where revenue really comes from. The naive view is that revenue comes from fixing things, a service call, an emergency repair, a new installation. These are transactional, unpredictable, and lumpy. The sophisticated owner understands that the real engine of the business is the service contract. Consider a company like Trane, where more than 40% of its revenue comes from contracts that generate margins of more than 30%. These are not accidents. They are multi-year agreements, often lasting 15 to 25 years, that provide a predictable stream of cash flow. The owner is not selling a repair. The owner is selling certainty. For the customer, a maintenance agreement means the air conditioner will not fail during the hottest day of the year. For the owner, it means a predictable revenue stream that can be used to secure debt, pay technicians, and plan for the future. This is the central tension of the HVAC business. The industry average net profit margin is somewhere between 5 and 12%, but strategically run companies can achieve 10 to 20%. The difference is rarely labor productivity. It is pricing discipline and the mix of revenue. A company that relies on emergency repairs might grow 60% on a service call, but the overhead, the trucks, the insurance, the office, the marketing, and the labor costs consume that margin before the owner sees any cash. A company that builds a book of maintenance contracts creates a foundation. The service work is the icing, the contracts are the cake. The cost structure of an HVAC company is where the owner discovers the true nature of the asset. The startup costs can range from $50,000 to $150,000 for a basic operation. This includes equipment, vehicles, licenses, insurance, office space, and initial marketing. But the real cost is not the startup. The real cost is the ongoing bleed of labor and overhead. The national average for residential service labor is around $75 per hour in net profit, but the overhead cost per hour is typically $40 to $50. The owner must price every job to cover the direct labor, the overhead, and still leave a margin. If the pricing is wrong, the shop can be busy and still lose money. The trucks can be full and the phones can be ringing, but the owner is effectively buying a job, not owning a business. Scale changes everything. At the small end, with one or two trucks, the owner is the technician, the dispatcher, the accountant, and the marketing department. The owner is trading time for money. At the large end, with dozens of trucks, the owner is managing a system. The owner is buying a system of technicians, dispatchers, inventory, and contracts. But scale introduces its own dangers. There is a famous example of a $2.1 million HVAC company that went bankrupt after buying truck number 11. At 10 trucks, the owner thought they had made it. Then they added one more truck, hired another technician, and suddenly the overhead, the management burden, and the cash flow demands became overwhelming. The business did not fail because of a lack of demand. It failed because the owner did not understand that adding a truck does not add profit. It adds complexity, risk, and cost. The legal environment does not stop at licensing. The HVAC industry is in the middle of a massive regulatory shift regarding refrigerants. The new generation of refrigerants is expensive, with some products exceeding $200 per pound. This is not a trivial cost. A single commercial system can hold hundreds of pounds of refrigerant. The owner must track every ounce, comply with leak repair regulations, and maintain detailed records. The law creates a compliance burden that crushes small operators and advantages large ones with dedicated compliance staff. The law is not paperwork. The law is one of the walls around the cash flow. The risks that can destroy the asset are concrete and brutal. The skilled labor shortage is a top concern for more than half of all contractors. Projections indicate that nearly 1.4 million jobs within essential trades could remain unfilled by the end of the decade. The owner cannot scale without technicians. The owner cannot train technicians fast enough. The owner cannot retain them without paying more, which squeezes the margin. Then there are the commodity prices. Steel, aluminum, and copper are core to the equipment. Tariffs and supply chain disruptions can make budgeting impossible. The owner can quote a job based on today's copper price, and by the time the equipment is installed, the copper has gone up 20%. The owner eats the loss. The most dramatic risk is debt. Private equity has flooded the HVAC industry, driving up acquisition multiples. In 2025, the median enterprise value to EBITDA multiple for publicly listed HVAC companies increased to 17.4 times. Blackstone acquired Champions Group for $2.5 billion at 18.5 times the company's earnings before interest, taxes, depreciation, and amortization. This creates a powerful incentive for owners to sell, but it also creates a trap. The private equity model relies on debt to fund acquisitions. The debt must be serviced. The cash flow must cover the interest. If the integration fails, if the technicians quit, if the contracts are not renewed, the debt becomes a noose. The Air Pros case is a perfect example. A multi-state HVAC services provider initiated Chapter 11 bankruptcy proceedings following significant operational challenges and mounting debt obligations of approximately $250 million. The company grew too fast, borrowed too much, and could not integrate the acquisitions. The asset did not fail because of a lack of work. It failed because the financial structure collapsed. Yet Sirius Capital still wants to own this business. The reason is not the product, the reason is the structure. A well-run HVAC company generates stable, high-margin, recurring revenue in an otherwise cyclical construction market. The industrial segments are particularly attractive because they involve mission-critical systems and long-term contracts. A hospital cannot survive without air conditioning. A data center cannot function without cooling. The owner of the contract has pricing power. The owner of the contract has a barrier to entry. The owner of the contract has a predictable cash flow that can be leveraged, securitized, and sold. The value of the business is not in the vans or the equipment. It is in the book of contracts. Recurring service revenue provides visibility into future cash flow, which lowers perceived risk for buyers. A business with a strong maintenance book might trade for 6 to 10 times EBITDA, while a demand-only business might trade for 2 to 4 times. The difference is the quality of the cash flow. The institutional buyer is not buying the ability to fix air conditioners. The institutional buyer is buying a stream of payments that are as close to an annuity as a trade business can provide. The owner who truly understands this business sees the pipes that corrode, the permits that expire, the contracts that can be breached, the workers who can strike, the lenders who must be paid, and the equipment that can fail at the worst possible moment. The owner understands that the business is not about the product. It is about controlling the legal rights, the contracts, the assets, the liabilities, the people, the costs, the risks, and the incentives that sit behind the product. The owner understands that the asset is valuable not because it is easy, but because it is hard. The asset is valuable because it is a bottleneck in a world that cannot stop needing air conditioning. The asset is valuable because the law, the labor, and the capital requirements make it difficult to replicate. The owner who survives is not the best technician. The owner who survives is the one who understands that the business is not the machine. The business is the structure that keeps the machine running.